Ken West. I'm a professor in the economics department here. And on behalf of my colleagues, let me welcome you to this talk by Professor Kenneth Rogoff of Harvard University on Is This the Beginning of the End of Central Bank Independence? Before I introduce Ken, I'd like to say a word or two about our sponsor, the Grainger Institute for Economic Research, and a word or two about logistics. So today's talk is sponsored by the Julie Plant Grainger Institute for Economic Research, or JPGI. This institute was made possible by a substantial investment in the Department of Economics by David Grainger and the Grainger Foundation. It honors a UW-Madison alumna named Julie Plant Grainger, who graduated in June 1948 with a Bachelor of Philosophy in Economics. Ms. Grainger was active over the years as a trustee or board member in many, many charitable organizations. She was an important partner with David Grainger in his career at W.W. Grainger, Inc., a family business founded in 1927, and she passed away in 2014. The mission of the JPGI is to, quote, be a visible and effective proponent of foundational economic research that confronts challenges facing the United States and the world, unquote. Thanks to this remarkable investment by David Grainger and the Grainger Foundation, in honor of Julie Plant Grainger, the JPGI advances this mission in a number of ways, including but not limited to undergraduate and graduate scholarships, research conferences and seminars for faculty, funds to attract and retain exceptional faculty, funds to bring distinguished visitors to campus, and last but not least, outreach to the public as exemplified by today's talk. We have one more outreach event upcoming this semester. It will be a full-day conference on Friday, October 11th on American economic challenges. In this day-long symposium, there'll be a set of distinguished speakers that come from not only academia, but also the private sector and from senior policy-making position in the United States government. The symposium will address a range of issues, including but not limited to higher education, healthcare, and trade with China. It's going to be fantastic. For more details, see the URL there, and we hope to see you there. All right, a few housekeeping details, including question and answer. We expect today's event to last about an hour, so end at around 5:30 p.m. We invite all of you for an informal reception afterwards, immediately afterwards, to be held right outside the doors there, and you'll have a chance to speak with our speaker, a whole bunch of econ faculty who are here today, and of course among yourselves. In terms of questions and answers, we ask that you do not interrupt the speaker. Let him proceed through his talk to the end. On your seats as you came in, there should have been a little piece of paper, and we ask that you fill out those slips of paper with whatever questions come to your mind, and there's no need to wait to the end. If Professor Rogoff says something that you want to ask about, by all means, write down your question at that point. Pass them to the end of the aisle, and we will have a couple of students picking them up, and at the end of the talk, the students will read the questions. All right, our speaker today, Kenneth Rogoff, is the Thomas D. Cabot Professor at Harvard University. From 2001 to 2003, he served as chief economist at the International Monetary Fund. His widely cited 2009 book with Carmen Reinhart, This Time It's Different, 8 Centuries of Financial Folly, shows the remarkable quantitative similarities across time and countries in the run-up and aftermath of severe financial crises. Ken has done widely cited research in many, many other areas of economics, including seminal work on exchange rates and on central bank independence. Ken's 2016 book, The Curse of Cash, looks at the past, present, and future of currency from standardized coinage to cryptocurrencies. His monthly syndicated column on global economic issues is published in over 50 countries. Ken's accomplishments and stature in the economics profession have been recognized in many, many, many ways, including, among others, election to the National Academy of Sciences, the American Academy of Arts and Sciences, and to the Group of 30. One final bit of biography, which is last, but in my opinion, certainly not least. Ken's first position in academia was right here at UW-Madison, where he was a professor in our department from 1985 to 1989. So in light of that bit of biography, let me ask you to join me in welcoming Ken back to Wisconsin, where his academic career began.
Thank you very much, Ken, for the introduction. Thank you everyone for being here. It is indeed a pleasure to come back to Wisconsin, and I have great memories of being here in many ways, but I would particularly say it helped develop me as a scholar. There's a seriousness of purpose to the department here. I know that those of you that are undergraduates saying, wait a second, didn't we rank in the top 5 party schools for 100 years in a row? But that doesn't necessarily, affect the economics department. And there's just, really deep, serious, critical scholarship and a great tradition in that. The title of today's talk, actually, I want to just switch to. Sorry, let's see how to switch to slideshow. I'm going to try. Very unresponsive. Okay. The title of today's talk is this the beginning of the end of central bank independence? And I just have to mention, actually, this title was half given to me because I originally gave a paper of this title. I'm going to talk about more than that at the G30 lecture, which is held at the International Monetary Fund meetings. And I was actually a last-minute substitute for Marty Feldstein, who unfortunately passed away recently. I don't think he quite knew how ill he was at the time, but wasn't able to do it. And all I knew was that he had the first line of this was his title. And I really wish I knew what he was going to talk about. I think it would have been much broader than what I'm going to talk about, so I added the second line of central bank independence, because I think this is an interesting period in that. So let me just give a brief outline of what I want to talk about. I'm not going to rely on my slides too intensely. I'm going to start by talking a bit about central bank independence. Why? What are the challenges, the political and technocratic? And then, depending on how much time I have, ideas I have for talking about it going forward. A lot of the material that I talk about sort of was developed. This is the 2017 paperback of my 2016 book, The Curse of Cash, and I really, really regret the title of that book for a couple reasons. First of all, I should have called it The Past, Present, and Future of Currency and Monetary Policy or something like that. I'd had an earlier paper which that was supposed to hearken to, which no one got. Instead, I have had over 20 death threats from people, I guess, who like cash a lot. And a lot of them, I think, were NRA members, so it's probably credible. And I also think it's a little misleading, the title, because I try to think it doesn't necessarily capture what it is, but that I nevertheless draw heavily on that. And then I have some papers, two about negative interest rate policy, which I'll come to at the end, depending on how much time I have, and then the lecture that I mentioned. And this is a picture of Ben Bernanke, who's the current Fed chair. On the right is Jay Powell, Janet Yellen before him, and there's Ben Bernanke, and they're very much involved in a year of, they say, reconsidering what their approach is going to be to monetary policy. Central banking today unquestionably faces a lot of challenges. And I'm not just talking about Donald Trump's tweets in the middle of the night about Jay Powell. I don't even count them now. There was a long understanding, since about the mid-'90s, that the White House wouldn't do that. And anyway, but you can see it all over the world. You can go to India, where Raghu Rajan, who was a fantastic governor of the Central Bank of India, got booted out by Modi. And then he was replaced by Patel, who was also very good. He's gone because he wasn't doing what he wanted. And you can go around the world. There are obviously very extreme cases like Argentina and Venezuela, but there's a lot of pressure on central bank independence. And this, I think it has its genesis in a few things. One is that for a while, central banks seem to be doing a great job. I'm not saying they're not doing a great job, just to be clear, but everyone kind of agreed. We gave them this assignment of keeping inflation low and trying to stabilize the economy. They did pretty well. Why don't we pile more stuff on them? So certainly during the financial crisis afterwards, and I'll explain more about this, they were pressured to do what I called quasi-fiscal policy. It's really not monetary policy. I'm not saying it can't be central bank policy, but it's not easily thought of as monetary policy, and I don't even think they have a comparative advantage in doing it, but they were pressured to do perhaps things that the rest of the government was reluctant to do. But recently, they're drawn into other things. The central banks are supposed to deal with inequality. You find increasingly in central banker speeches this coming up. And a new one I just can't even get my head wrapped around is there, and let me say what it is first, is helping with the environment. And I don't just mean, recycling paper that they use at the central bank. They're somehow supposed to deal with the environment. And those of you that are economics majors and you've had a course in this, they really have like a lot of tools for doing that are normally given to them. You could throw out the Environmental Protection Agency and give that power to the Federal Reserve, but you might find that the Federal Reserve came under a lot of the pressures that the Environmental Protection Agency comes over. So their remit is very wide. And then there's certainly the populism worldwide. I mentioned the tweets, but in the UK, Jeremy Corbyn, and I don't want to try to handicap that, he's the Labour leader, and I don't think he'd mind being called left-wing Labour leader, has talked about, he calls it the people's quantitative easing. He wants to have the Bank of England print money to do all sorts of stuff that he wants to do. I realize some of you haven't taken economics courses and might not, see why there's an issue with that or could ever be an issue. I'll try to come to it. We have the same thing in the United States. There's this idea of modern monetary theory, which is neither modern, monetary, or a theory, but has been promoted very heavily, basically the same idea. Let's have the central bank print money to do what we want to do, with the assumption that there either won't be inflationary consequences or, we'd have time to deal with them. But there are also problems, so that those are sort of on the political side. There are also problems on the technocratic side, and I think a lot of it has to do with the decline in interest rates, which has made it increasingly difficult for the central banks to conduct normal monetary policy, meaning moving the interest rate around. And when I say they move the interest rate around, for those of you who don't know, it's the very short-term interest rate that most countries' central banks really have control over, the one-day loan to the government that you make. And they have a lot of control over that. But the problem is as interest rates drift down, there's less and less room to cut interest rates. And maybe I'll show you a couple more graphs. This is goes back to 2000, a 10-year inflation index U.S. Treasury bond. So it's a proxy for the real rate of interest, the interest rate minus the expected inflation rate. And you can see it was hanging, it reached as high as 3%. It was mid-twos. Actually, when I was a graduate student at MIT in the late 70s, Gene Fama, a great finance economist who's a Nobel Prize winner now, gave this paper at MIT insisting the real interest rate was like Planck's constant at 3%. And of course, it's come down a lot, and now it's very low. Inflation, I'll talk about in a moment. This is from a paper by Holston, Laubach, and Williams, which looks at trend growth. That's the higher line, but it's an estimate of what the normal interest rate is, policy rate is, interest rate is for advanced countries as a whole. It's not just the U.S. It averages. Advanced countries, it's like under 1%. And to try to put that in perspective, when we have a recession, the Fed has traditionally cut interest rates by 5%. So if you're starting at 0.5%, there's like not a lot of room to cut interest rates. Let me just show you one more graph in this line. This is from a history department dissertation by Paul Schmelzing, and doing economic history. And I was on his committee. He just defended. I'll just say so this goes back to the Venetian city-states of the 1300s. I'm not going to vouch for every data point in it, but he's a really good guy. And he has a view that, yes, there have been spikes in these real interest rates, but real interest rates have been coming down. This is actually the nominal interest rate, but you got similar things for looking at the real interest rate. So this decline in interest rates presented a lot of challenges, and I think one of the ways central bankers have a little bit put some rope around their neck is they still want to get in there and be part of the action. So they've tried to think of other ways that they could use monetary policy to be effective. And I'll talk about it more, but the most important other way is they use their balance sheet in order to try to do stuff that they can't do with the interest rate. And using their balance sheet largely means issuing very short-term overnight debt. They control that, and buying long-term debt, in some cases buying private debt. And I think the first thing to understand, which a theme I'll repeat several times over the course of this lecture, is the Federal Reserve is independent, and I'll talk about that a lot, but it doesn't have its own set of books. It's actually a wholly owned subsidiary, 100% of the Treasury of the United States government. There is no, independent balance sheet of the Federal Reserve. You have to integrate them. The Federal Reserve's profits are completely turned over to the government. Yes, they can pay themselves a little higher salaries, take a little bit out, but that gets regulated too. Their independence is very limited. So when they try to use these other instruments, they're creeping into other territory. This is not their territory. It's not normal territory. So just to put this in perspective, during the financial crisis, the Federal Reserve did a lot of this. It ramped up its holdings of other assets, much of it long-term government debt and long-term government guaranteed mortgage bonds, to $4.5 trillion. So it took $4.5 trillion of kind of long debt, turned it into overnight debt. So the public is holding overnight debt instead of this other stuff. But you have to bear in mind that the Treasury over this period has been turning over about $4 trillion that it's had to refinance per year. And if the Treasury felt like having the debt be really short term, it has overwhelming force to do that. It can, instead of issue 10-year, 30-year debt, it can issue 1 week debt. Right now, that's the shortest we have in the United States, but it's pretty much the same thing. So trying to insert yourself into this process on a long-term basis, it's probably, Congress didn't even know they could do that. And I think in a lot of countries they didn't realize they could do that, and somewhat inserting themselves into policy. So there are a number of challenges. Well, let me start with sort of the first question is, who cares if they're independent? And let me tell you, that question's coming up a lot. Why would you care that you had an independent central bank? And actually, it's a relatively new thing. It didn't always exist. In fact, for most of history, most central banks either were on a gold standard, meaning they really didn't have a lot of control. They had some limited control, but basically they had to trade their currency for gold, and or they're owned by the government. They're part of the government. The U.S. Federal Reserve before the Great Depression was a room in the Treasury. It wasn't this big grand building that you see on the mall now. They just were a little office of the Treasury. In the United Kingdom, they only made the Bank of England independent of the Treasury in, I think, 1996, when the Labour Party came in. It was one of their radical reforms. Didn't exist. If you go back, just a colorful example, the first central bank in Spain, I think it was 1788, the king was Charles III. The name of the central bank was the Bank of St. Charles, which kind of captured what it was about. And I think there's a lot of confusion, even among relatively sophisticated people, about how new a phenomenon this is of central bank independence. There was a wonderful book written, I think it was published in 2009 by Liaquat Ahmed, won Pulitzer Prize and other stuff. It's called The Lords of Finance, where he takes 4 central bankers, important figures in history during the 20s and 30s, Benjamin Strong in the United States, Norman Montague in the United Kingdom, Bank of England, Emile Moreau, who was the head of the Bank of France, and Helmut Schack, who was the head of the Reichsbank. And he kind of lays the depression on them and says, they screwed up, that's why we had the Great Depression. And it's certainly a little bit of an exaggeration because, that they were not running the show. When the UK, until Brexit, made, its worst macro decision of certainly the last many hundred years, they decided to go on the gold standard in a very inept way. It returned to the gold standard in 1925 in a very inept way. But that wasn't Norman Montague's decision. That was Winston Churchill's decision. He was the Treasury Secretary. He was calling the shots. And you can go around. It is a relatively new thing to have them be this independent. So why did it happen? Well, it largely happened because in the advanced countries, inflation got out of control. So in the United States, it was bad. I think inflation went up to 13 or 14% in the 70s. In the UK and in Japan, this may be hard to get your head wrapped around, it was over 20%. And you go outside there, in 1992, 44 countries in the world had inflation over 40%. Now there are only a couple now and then that have that happen. There's been this transformative change. And I would submit that central bank independence was a way that countries approached it. It's a way that countries dealt with the problem. You gave the central bank control over how much money to print. And I don't have Randy Wright here, can give you a much more thorough explanation of what that means. But I don't want to get into the details exactly. But they control the money supply, they control the short-term interest rate, and that's it. They do a bit of regulation, a bit of other stuff. Unless there's an emergency, they don't get into other stuff. And you say, you have control over that. And that turned out to be a very effective way to enhance credibility. I believe it was. Actually, the paper that got me my job at Madison was about why you should have an independent central bank. I have a quarterly journal of economics paper about that and how it might be used, and you could choose how you could have inflation targets and other things. It's changed. They did a lot of other things beside that. I would say they locked in, the countries locked in, trying to have low inflation in a lot of ways. Independent central bank, I think, was the most important. And if you go around the world, inflation has just collapsed. Not in Venezuela, not in Argentina and occasionally in another country, but inflation's just collapsed. And I think if, there are other factors that have led to that. It's very hard to look exactly, but I think if you look at the timing of when countries have their inflation rates come down, the central bank independence plays a great role. And today, the inflation rate in the advanced countries is projected to be 1.6% this year by the IMF. And the target's 2%. They're not even getting it up at what they're aiming the target to be at. And again, I mean, I just have to give you one example from Argentina, where I had a former graduate student involved in the central bank during the Kirchner regime, not the current regime, which has had its own problems. The central bank policy literally consisted of loading up trucks with cash and sending them to the Treasury. I mean, it was little short of that, which is, of course, what it is in hyperinflations. So I think one of the problems central banks face, good or bad, is a lot of people just think we don't need them anymore. I'm amazed at how many people I come across who just say with conviction, well, you just can't have high inflation in the 21st century. Our economies just don't permit it. So we don't need the central bank to be independent. I don't think we can dismiss any point here. We don't understand inflation, but that's certainly one of the things that's undermining inflation, central bank independence. Another thing, for sure, I really addressed a bit, which is that when interest rates are very low, the tools that central banks have are not really very independent tools, because the interest rate doesn't have far to go. You may not know this, but in Europe and Japan, they already pushed their interest rates a little bit below zero, and they don't know how much further they can push them. And they haven't even had a recession yet, much less a financial crisis. And here, we're a little over 2%, depending on what you want to call it. Again, there's not a lot of room, and there are these alternative instruments. Ken West has written about this, who introduced me, and it's something I discuss in the book. But here's an analogy I would make about quantitative easing, and I don't know, maybe it's too crude, but you can look at any of the armed services, and the Marines have their own planes, their own ships, even the Army has some planes. And if the Air Force can't send in planes and none of the aircraft carriers are available, maybe you use some of the Army planes to do something. But if you really wanted to do a major operation, you'd want to use somebody who had a lot of planes. And the Treasury issues a ton of debt, and it turns over a ton of debt. And if you really wanted to do these operations of shortening the maturity structure of debt, you would use them. Now, Ben Bernanke's very vigorously defended these policies, saying they work. Actually, let me just show you. This is from Jackson Hole speech Janet Yellen gave. She was the chair. And listen, she has to defend the policies. So she was addressing the question. Everybody's asking us, what would we do if there's a recession? Interest rates are already, at that time they were zero. What can we do? And so she produced these charts, which had been done by David Reichschneider and colleagues. And in these charts, the red dashed line, so she asked the question, suppose we had a recession, not quite as bad as the financial crisis, but sort of like the 1980s, a bad recession. So you see the dashed red line, the short-term policy rate gets cut quickly by 5 or 6%. That's what I told you is the norm. Then the other two look at the federal funds rate of how it moves The one that's the solid black line, so I've been talking the solid red line. The solid black line is, I'm sorry, let me look at the dashed blue line first. It's what you would do if you follow the usual constraints. You don't use these quantitative easing and other things they have, forward guidance. And then the solid line is what happens to the Fed funds rate. And you can look over, for example, at the unemployment rate in the bottom left-hand side, and the black line, the Fed's using their instruments. It works better than negative interest rate policy. It's just fantastic. And her model that she's using, negative interest rate policy, works fine. There's no issues with it. You restore inflation faster in the lower right-hand corner. I could illustrate more there. That's sort of the official party line. But I would say, and I don't have time to give all of it, but many economists are pretty skeptical about this. Jim Stock, my colleague, was asked to give a paper on this Federal Reserve Review asking how well Fed policies had worked. And he tries to strike what he regards a middle ground. I would say it's quite positive relative to many of the academic theorists, anyway, what like Mike Woodford would think, although, you know, a lot of the Federal Reserve were horrified that he wasn't finding bigger effects from it. So if there is a recession, there's a question if the Fed has the tools. I think it's a very real question. And I'll add, I don't have time to show it. I have a paper from May and doing another version of it with a graduate student, Andrew Lilly, where we sort of try to argue that part of the reason you got any effect from quantitative easing the first time, and I don't mean, I don't, for those of you that are in the weeds here, I don't mean during the first day of the crisis, that's called QE1, but during the later rounds of this, it was mostly because markets didn't understand. They actually thought inflation might end up being really high. You can look, and they've now learned. In Europe and Japan, they learned a long time ago. They've had this going on for a long time. There are other policies that have been suggested. Another idea that I can't tell you how popular it is this notion of helicopter money. That comes from Milton Friedman, actually, but Ben Bernanke, I think in 2003, was in Japan. He had just really come into the public eye. He wasn't head of the Fed yet. He gave this speech explaining one thing a central bank can do is drop money from a helicopter all over the country, and that people would spend it, and that would create inflation. Now, those of you that have taken macroeconomics know that's actually a combination of fiscal and monetary policy. And the Federal Reserve actually doesn't have the power to do that, to hand out money to people. It has the power to buy bonds from people, or to sell bonds to people, but it doesn't actually have the power to hand out money. But this is an incredibly popular idea. And I think the problem is the Federal Reserve is independent, but if they were deciding, I don't know, everybody at the University of Wisconsin gets $100 and everybody at the University of Michigan gets $150 and had some argument about that, I don't think you'd like that very much. And that's a decision. Those are kinds of decisions Congress makes. And if the central bank starts making them, that's not going to work. But it's an incredibly popular idea. You see it all the time. Front page of the cover of Time magazine is one of the great ideas. The Economist has pitched this as just an amazing idea. A related idea that I also hear all the time is the U.S. has so much debt, but the Federal Reserve's holding part of it. Let's help. Why doesn't the Federal Reserve just tear up the debt that it holds and say this? You see this all the time. One of the reviews of my book said, obviously, Rogoff doesn't recognize this great idea that would solve all the problems. And that's a little bit like, you know, you have a family and one family member owes you money and you tear it up, but it doesn't really change the financial position of the family altogether. The Federal Reserve is owned. So I think there's a fundamental problem that there's somewhat limited options that central banks have. Now, another challenge facing central banks, of course, is what to do if there's a financial crisis. I think this is different because then when markets freeze, that is a role of the central bank, which I think is still valid. Some people call it the market maker of last resort, and where they have credit when nobody else has credit. So I have to say the Federal Reserve was incredibly creative in doing this during the financial crisis. I really give them a lot of credit. They would buy car loans, consumer loans. They guaranteed money market funds, just things you think you'd see in China maybe, but you wouldn't think you'd see in an advanced country. The craziest thing, and I thought I was hallucinating when I woke up and heard this, is they took the big investment banks, Goldman Sachs, Morgan Stanley, JP Morgan. They're not allowed to give them money directly. They're not allowed to tap into the central bank. So they just said, okay, they're banks. Now we can give them money. They just, it did these incredibly creative things. That's certainly a role for the central bank. But at the end of the day, they are using the government's balance sheet to do this stuff. We see this in emerging markets a lot, and in our case, it worked out fine. They didn't lose money, and they made money, arguably. It is an arguable point. But a lot of times you could have lost money because in emerging markets they do, and you have to have the Treasury come and clean it up. But then once they do the initial stages of the financial crisis, there's limits on what they can do, and I think I've sort of I've talked about that. Now, another issue, sort of related to the ones I've talked about, is that early on, when it was the Bank of St. Charles and similar things for other central banks, their job was to get the government debt funded, and if nobody else would buy it, they would buy it, and they would buy it from the private sector, printing money, or just give the government directly money to do it. This is, I mentioned Argentina. This is how you see the German hyperinflation unfold. There's a view that the government could play this, the central banks. We don't have a problem with inflation. That is not a 21st century phenomenon. It's just something that we don't have to worry about anymore, and we can just play this game forever. So I mentioned modern monetary theory, which I'm sure I won't give a fair description of, but it's basically let's pay for stuff, having the Fed do quantitative easing, which is basically like saying let's do very, very, very short-term debt to pay for everything. A parallel thing would be to say let's have the Treasury do all 1 week debt because it's cheaper than issuing longer-term debt, at least normally it is. That's perfectly fine. And by the way, I think the United States has a lot of room to have higher debt, and a lot of countries do because interest rates are so low. But I would challenge the view that it could go on forever, and I would challenge the view that you should borrow it all short term. The U.S. is not a hedge fund where you can just retire in 3 years. Oh, well, the president can, but where you just can step aside. We want to be in business for many centuries to come, and stuff happens. And to just set ourselves up so we've borrowed everything possible at 1 week debt, 1 year debt. And by the way, the duration of our debt now is not even 4 years, the average time it takes to turn over stuff. It's like in the 1970s. That's very risky. But it certainly, you could do it for a while. And I mentioned that idea has been prominent in a number of places. Olivier Blanchard, who's a very distinguished macroeconomist who also was chief economist after me and Raghu Rajan at the International Monetary Fund, he gave a very widely cited speech at the American Economic Association meetings, in fact, the presidential address, where he basically said that as far as the eye can see, countries are going to grow faster than the interest rate they have to pay on debt. So let's just, have a lot more debt. That's a more coherent view. Those of you, again, that are in the weeds know that we have to be in a dynamically and efficient economy for this really to make sense, meaning we've just invested much too much globally, not just nationally. And well, maybe that's true. But this is, again, turns to be pressure on central banks, because if debt's not a problem and you can just issue debt, it's not going to create inflation, it's not going to create pressures, who needs an independent central bank? And maybe it's true. My conjecture would be that when we get rid of them, we'll live to regret it. And certainly the younger people in this room, I can promise you will see high inflation. I'm just looking at the tea leaves of what the political winds are. I think they will try a lot of these ideas. There are really a lot of political push for them. And it's nothing bad's probably going to happen right away, but do it for 10 or 20 years, and I suspect stuff might happen. Let me close briefly with some discussion of negative interest rates, which I could give a whole talk about. I believe that that's something that is the future of central banking with these low interest rates if they stay. And it's a very emotional topic because I think a lot of people don't quite understand what's involved. So right now, they actually are negative. In fact, if you get a mortgage in Denmark or Switzerland, you pay a negative nominal interest rate on it. Believe it or not, it gets worth less every year. They're in negative interest rate territory. They're not very deep in it. And the major, so my vision would be this isn't a permanent thing. If you can get an economy back to normal, you wouldn't need to do this. But if you needed to cut interest rates a lot in a recession, it's a vehicle for doing that. There are some small institutional issues. I don't have a lot of time to talk about it, but I think they're pretty small. The biggest one is dealing with cash. My book, I invite you to read it, has a number of ways to deal with it. But basically, one thing that's pretty robust is to exempt most small savers, but then for large institutions, if they want to take a lot of money and hold it in cash, which pays a zero interest rate to avoid the negative interest rates, you tax them when they bring money back into the system. And there's some clever ideas for. I'm going to quickly skip through a million slides. I just want to mention that Keynes actually thought negative interest rates was a great idea. And if you read his, in theory, and if you read the general theory, he has a whole chapter about it. And he reaches his conclusion that we need a lot of government spending because he said you should always use government spending, but that we should rely really heavily on it because there's no room to cut interest rates. They hit zero during the Great Depression also. And he was aware of this work by this rather maverick economist named, a business person named Silvio Gesell, who'd written books about having negative interest rates. How do you have negative interest rate on cash? Gesell had this idea you would have to put a stamp on the back of it every week, and you buy the stamp, and the price of the stamp is the negative interest rate. And he wasn't aware that there was like a better idea floating out there by a complete outsider named Robert Eisler. That's Robert Eisler on the left. That's Kublai Khan, who's the grandson of Genghis Khan on the right. Actually, it's Benedict Wong who plays him in the TV series because we don't have a picture of him. But the idea, I trace in my book to Kubla Khan actually had done something like this when Marco Polo writes about it. So Eisler had a fairly sophisticated taxation, moving taxation scheme that simulates having a negative interest rate, and I will skip that. This is from my paper with Andrew Lilly, where from May, where there were actually at times after the financial crisis, financial markets actually placed some probability of having negative rates. And this ends in March, I think, but it's gone up again. So the financial markets see this as a possibility. My book talks a lot about reducing the level of cash, but I don't have time for that today. I'll just finish this as a picture. Please don't send me any death threats, but I would welcome any questions. Fantastic.
All right, so our first question is, after the recession, the Federal Reserve regulatory role also expanded along with its balance sheet. Do you think this has brought the Fed under more political pressure?
That's an extremely good question, and I neglected to talk about that more. So in England, they actually went to the extreme of pushing regulation out of the Bank of England completely. And that probably was not a good idea, because in the financial firefighting role of the central bank, there's a huge crisis. If you don't have relationships with the financial institutions that you can draw on instantly, it's much harder to deal. And so it is important that the Federal Reserve have a regulatory role. But absolutely, you come under a lot more political pressure. I think the Federal Reserve's done a good job of insulating from this political pressure, but there are just limits. It's a very good question. I don't have a really short answer. I do refer you to a book by Paul Tucker, former number 2 at the Bank of England, called Unelected Power. And it really observes how far can you push this paradigm of having the central bank independence? Where are the roots of that? How deep they're not elected? What kind of decisions can you have them make? In the case of regulation, they're picking winners and losers all the time. And I think that I recommend that book.
All right, the second question is, do you believe the Fed could improve its potency by changing the framework, like targeting the price level or NGDP?
Well, I first advertised my 1985 paper, which looks at nominal GDP targeting. And I was told then, and I've been told much more recently by people in the Federal Reserve. So, that's a non-starter, because no one knows what that is. And how can you announce your target as something which no one knows what it is? I think the main problem with targeting nominal GDP, and I apologize to those of you who don't know what it is, that's the official number of what our output is every year, called 21 trillion, something like that at the moment. And the idea is by targeting that, you get a combination of output and inflation that might smooth out the business cycle. And it creates a very obvious political role, because you kind of have in your nominal GDP target a growth bias built in there. So in my 1985 paper, I discuss it. I showed that it had good properties, but that it had this bias. And the price level target, there are credibility problems with it. There's an idea, well, if we haven't had a lot of inflation for a long time, we'll promise that we'll let it go higher to make its makeup. I'm targeting a price level, the level, not the rate of change, the inflation. So if inflation's been low, I'll let it be high. And needless to say, it's very difficult to do this. They're all holding their breath till they're blue in the face right now to convince the public that they want to do that. And inflation expectations just keep coming down and down, so it's difficult to make credible.
All right, our next question is, what is the impact of monetary policy in a summarized sense on inequality and on productivity improvement?
So on product, I mean, to a first order approximation, 0 on both, I think is the first thing to say. On productivity, if you don't have a stable monetary system, this is not good for productivity because nobody knows how to write contracts and make deals. Inequality, my answer is a little too glib because obviously when you cut interest rates unexpectedly, it redistributes income from creditors to debtors. The government usually has itself in mind as the debtor that it's trying to favor, but in principle it favors debtors. But it's a little tricky because if you're always trying to do that, then nobody trusts you, and at least in theory, inflation would end up being higher and everybody loses. Milton Friedman, Ned Phelps had the famous Friedman-Phelps-Phillips curve, which sort of said you can't permanently tilt the playing field. So the Federal Reserve actually can, somewhat randomly, redistribute income through its monetary policy, but it's very hard for it to do systematically. That's a glib answer, I know, but I think to a first approximation, correct.
All right. And our last question is, do you believe the global growth slowdown has more to do with demographic factors, productivity, or geopolitical instability?
So I don't think there's any arguing with the demographic factors. I'm more skeptical about the productivity. I used to be a professional chess player in high school and my early years in college, and I still follow AI through that lens, and it's just crazy, the developments, and I actually think that's leaking out into other things. And so I'm someone who believes productivity, when we measure it right, will end up being quite high in this century. And I will add to that, when I talk to my older colleagues in computer science, physics, biology, chemistry, and ask them, is it true that we're not discovering ideas anymore? No, I think it's like, yeah, I guess my 1975 paper was kind of the last word in my field and nothing's really happened. But then when you talk to a 28-year-old, they're just bubbling, with everything that's going on, as I hope most of you are. So I'm skeptical of that. The geopolitical until recently, a lot of the empirics is that it was getting better and better. Unfortunately, we may be in the first inning of it getting worse. Harold James at Princeton has a very nice book from about 10 years ago, where he points out that globalization is not just something that goes up steadily, it goes in waves, and he predicted we're due for a down, and that book, unfortunately, seems like a very good prediction, and I don't think that's going to be good for growth.